In our last session, we explored the complexities of managing liquidity across borders, dealing with fragmentation, ring fencing, and regulatory variation. It was a reminder that managing liquidity isn't just about keeping score, it's about being prepared. Now, that theme continues in this session, where we turn our attention to one of the most vital, forward-looking tools in a bank's liquidity toolkit: liquidity planning and forecasting. In this session, we'll explore how banks anticipate their future liquidity needs across different time horizons, how they connect liquidity forecasts to business strategy and market dynamics, and how they balance flexibility, realism, and control in planning processes. By the end, you'll see how good liquidity planning does more than prevent crisis. It helps a bank grow confidently and sustainably. So let's begin by understanding the purpose of liquidity planning. Now, at its heart, liquidity planning is about anticipating the future state of the bank's liquidity profile, so the firm can prepare for both expected needs and unexpected shocks. It's about ensuring that as the bank grows, launches new products, takes on new risks, or responds to external events, it always retains enough flexibility and funding resilience to adapt without panic or disruption. Now, liquidity planning operates across multiple time horizons. The shortest time horizon is intraday, where Treasury ensures payments and settlements are made smoothly throughout the business day. Next is short term, typically the next 1 to 30 days, which is where metrics like the LCR and cash flow forecasting models are focused. Then comes medium term, often covering the 1 to 3 month window, where banks assess funding rollovers, maturing debt, and short-term investments. And finally, there's the long-term horizon, spanning 3 months to 1 year and beyond, which aligns closely with NSFR compliance, business strategy, and structural planning. Now, each of these horizons requires a different approach, different data, and different tools, but they must all be connected through a coherent liquidity planning framework. Now, at the center of that framework is the liquidity forecast, a model that projects expected inflows and outflows of cash under business as usual conditions over different time periods and with varying levels of granularity. Now, liquidity forecasts are typically built from the ground up. They start with known contractual cash flows, such as maturing loans, deposits, debt repayments, and coupon payments, and then overlay behavioral assumptions, planned balance sheet activity, and expected business growth. For example, a bank might forecast that 200 million of corporate term deposits will mature next week, but expects only 150 million will roll over based on past behavior and market conditions. It might expect to disperse 300 million of new mortgage loans in the next month, which will reduce liquidity but increase asset balances. Now, these forecasts must be updated regularly, daily for short-term windows, weekly or monthly for longer-term horizons. Now, the quality of a liquidity forecast depends heavily on the underlying data. Now, that includes core banking system data, treasury systems, customer behavior models, product level cash flow schedules, and market assumptions such as interest rates or FX trends. Many banks use dedicated forecasting platforms that pull data from multiple sources, reconcile positions, and produce scenario-based outputs. Now, these platforms allow treasury and risk teams to visualize liquidity gaps, test what-if cases, and track changes over time. A strong forecast doesn't just track cash, it anticipates drivers of change. Now, that includes planned issuance of debt, customer deposit flows, seasonal lending peaks, expected dividend payments, and corporate actions. It also includes regulatory requirements, such as maintaining minimum buffers or meeting internal liquidity targets. Some forecasts include contingency assumptions, allowing users to toggle between base case, stressed, and crisis scenarios. For example, toggling a button may assume a 10% deposit outflow or a delay in wholesale refinancing. Now, liquidity planning also requires alignment with the bank's strategic plans. This means integrating liquidity forecasts with business forecasts so that asset growth, customer activity, and new initiatives are matched by appropriate funding strategies. Now, Treasury must work closely with finance, strategy, and business units to ensure that plans to expand lending, invest in new markets, or launch new products are reflected in the liquidity planning cycle. For example, if a bank's retail business plans to grow mortgage lending by 20% over the next 12 months, Treasury needs to assess whether the existing funding structure can support that growth. Will deposits be sufficient? Will new bond issuance be needed? Will the change affect LCR or NSFR compliance? These questions are answered through integrated planning processes, often tied to the bank's annual budget and capital planning cycle. Now, in many institutions, this is formalised through a liquidity planning committee, a subgroup of ALCO, or as part of the annual ILAP process. The committee reviews forecasts, sets internal liquidity targets, approves funding strategies, and monitors performance. Now, liquidity plans are reviewed quarterly or semi-annually, and major assumptions such as behavioural profiles, market capacity, and contingency tools are subject to independent challenge. A common tool used in liquidity planning is the Maturity Mismatch Report, also known as a liquidity gap report. This shows expected cash inflows and outflows across defined time buckets, say daily for the first week, weekly for the first month, and then monthly thereafter. The gaps can be positive, i.e. a surplus of cash, or negative, i.e. a need for funding. Now, these reports help Treasury visualise pinch points, plan actions, and allocate buffers accordingly. Many firms produce gap reports by currency and legal entity to capture the impact of fragmentation and local market dynamics. Another essential element is the funding plan. Now, this is a formal document that sets out how the bank intends to meet its funding needs over a 12 to 18-month horizon. It includes targets for debt issuance, expected changes in deposit balances, planned use of repo or central bank facilities, and contingency arrangements. The funding plan is aligned with the liquidity forecast and is submitted to regulators in many jurisdictions, including the UK and EU. It's often reviewed by the board and shared with rating agencies and investors. Funding plans also cover market access assumptions. For example, how much the bank expects to issue in the senior unsecured market, what tenors are targeted, what currencies will be used, and which investor segments are being approached. These assumptions are informed by market conditions, historical issuance data, and dialogue with investors. The plan may also include plans for green or ESG labelled issuance, aligning with broader sustainability strategies. Now, stress scenarios are often embedded into liquidity planning. For example, what if wholesale markets are closed for a month? What if a large deposit client withdraws 50% of their balance? What if the bank is downgraded by 2 notches? Forecasts can be adjusted to simulate these outcomes, allowing Treasury and risk teams to plan actions in advance, such as increasing buffer size, slowing asset growth, or shifting funding mix. Some banks take liquidity planning a step further by integrating it with capital planning and recovery planning. Now, this is often referred to as integrated balance sheet management. The idea is that liquidity, capital, and earnings are interdependent and must be planned together. For example, issuing more long-term debt to improve NSFR may impact the net interest income. Growing assets may require more capital and more liquidity. Recovery actions, such as selling assets or cancelling dividends, must be assessed for their impact on liquidity and funding. Now, technology plays an increasingly important role in planning and forecasting. Leading banks use AI and predictive analytics to model deposit behaviour, market trends, and funding costs. They simulate forward curves, volatility scenarios, and even behavioural changes in customer activity. They integrate forecasts into dashboard tools, allowing Treasury and ALCO to monitor key metrics in real time and drill into drivers. Now, these tools support faster, more informed decisions and reduce reliance on static spreadsheets or manual aggregation. Another development is cloud-based planning platforms, which allow distributed Treasury teams across regions and legal entities to collaborate on a single liquidity view. This is especially valuable for cross-border banks, where entity-specific planning must be rolled up to a group level. These platforms also support automated reporting, audit trails, and scenario comparisons. And as always, governance is key. Good liquidity planning requires clear ownership, well-documented assumptions, and regular challenge. Treasury owns the forecast, but inputs come from across the bank: finance, risk, business units, and even compliance. Assumptions must be reviewed regularly, stress-tested, and adjusted as needed. And it goes without saying that the board and senior management must be engaged in the planning process, not just presented with the outputs. Planning is not just about numbers, it's about insight, alignment, and readiness. And finally, it's worth noting that liquidity planning is not just a defensive tool, it's also an enabler of growth. A bank with strong liquidity planning can launch new products more confidently, enter new markets more effectively, and respond to opportunities faster than its peers. It can signal stability to regulators, investors, and clients. It can absorb shocks more easily and manage uncertainty with greater control. To summarize, liquidity planning and forecasting sit at the heart of proactive liquidity risk management. They turn compliance into capability, risk into readiness, and numbers into strategy. They connect the present to the future and allow banks not just to survive, but to succeed. In our next session, we'll begin to look outward at the future of liquidity management in a changing world. We'll explore how emerging technologies like artificial intelligence, digital currencies, and real-time settlement systems are transforming liquidity risk and treasury operations. I'll see you in the next session.